Hi, good afternoon, everybody. Scott Riley, the Market Update Desk, October 15th. Well, in sports news, we had a complete game shutout last night by Yamamoto of the Dodgers. First time, I believe, a shutout in the playoffs since 2004, if I'm not mistaken. Kind of interesting. So, in the business world today, we saw yesterday Fed Chair Powell spoke and made some new comments on the Fed's balance sheet, which is very interesting to pay attention to. Now, he indicated that there are signs of liquidity tightening and that the Fed may need to stop reducing the balance sheet in the coming months. Now, this is a good thing as it would reduce supply out there and have more opportunity for um, investment funds, international buyers to pick up those and not have as much inventory on the market, making the pricing better. Now, there's a good chance that there's going to be an announcement, probably the October 29th meeting of a formal reduction in runoff. This could have very positive impact on rates. Currently, the Fed is allowing up to about 35 billion per month in mortgage-backed securities runoff and 5 billion a month in treasuries to roll off their balance sheet. Now it's unclear how much of the allowed 35 billion runoff is actually being reached, but it's likely to believe that they are short on that, and they're probably running closer to about 15 to 20 billion. Now, the Fed stops the runoff altogether, then the Fed would reinvest the likely 20 billion plus per month that they're allowing to fall off the balance sheet. Likely that reinvestment is going to be into treasuries. So Powell feels that the Fed is overweight on long duration treasuries versus short term duration. Their average duration right now on their treasury holdings is about 7 years. That means the Fed will likely focus their purchasing on similar duration towards the shorter end of the maturity curve. Now, this will help rates, especially if Bessent is successful in terming out our debt into shorter term issues versus long term paper. Um, Powell finally acknowledged the Fed should have stopped quantitative easing or bond buying much sooner than what they did. And as a result, it contributed to the higher inflation that we had. Now, he also appears to be getting more comfortable with tariff inflation being temporary, or their Fed's favorite word, transitory. And while he's coming around to the labor market being weaker, he's still not there, which is surprising based on the weakness, the drastic weakness we've been seeing the last 6 to 10 months. Now, the balance sheet was good news for the bond market. In fact, we're actually seeing 10-year treasuries inch closer to that 4% and sub 4% mark. We're at 4.0340 as we speak right now. Now, if we can break through the 4% marker, the next downward resistance is 3.91. Now, we've been here countless times trying to break through and hold below 4%. The last time we broke through 4% was pre-Fed cut in September. Immediately after the announcement, we bounced back up to about 4.2. So we're going to see if we can get that move lower, and the key is holding it. Now, mortgage applications for purchases fell about 3% last month. But keep in mind, they were up 20% year over year. Refinances fell 1%, but year over year, they're up a staggering 59%. A lot of people are consolidating high cost debt, looking at their global interest rate and cost structure, their blended rates. We're helping people walk through this process and showing them how refinance can actually help not only pay off that debt that's higher rate, roll that back into the mortgage, the payments, and pay off the mortgage faster, even if they had a lower interest rate on their mortgage. So give us a call. We'll help run through numbers with you and help you out. In fact, we've got another offer going in today that we've been working on. Looks like it's going to go through. So we're having a lot of success here at the Market Update Desk. Give us a call. Put our knowledge and experience to work for you. 616-293-2189. Hope you have a great afternoon.